Phil, most people think insurance research just means getting a few quotes. Why is that a misunderstanding?
Yeah, so when it comes to financial advisors, there is a lot of research when it comes to insurance, and the actual price and the cost of the cover is kind of almost the last step. So doing these quotes with insurers is the last thing, because first we want to know, based on your health history, what cover you're going to get. So if you are unable to get certain covers because of your health or occupation or your age, then that'll impact what type of cover we get and what the different levels of cover. So always, number one, it's based on your health history. Number two, it's then talking about, okay, what levels of cover do we think is important? And then once we've done all of that research and kind of put those puzzle pieces together, then we go and run the quotes with the different insurers and determine, okay, which insurer we're going to go with.
So that's akin to when I log in and do my car insurance. They just don't say what type of car you've got, what's your age and address, here's the price. They'll ask, have you been in any accidents? Is there hail damage? So the price is almost a result of the information that's fed in, and that can vary for everyone, right?
Exactly. And the difference with like home and contents and car insurance is most of the data that they use is public data. So what's the crime rate in a certain suburb? So that's why your car insurance may be different based on what suburb you are. When it comes to life insurance and personal insurance, it's all based on your individual health history and your individual situation. And that is so much more difficult to underwrite from an insurance point of view. So they can't just like pick our health data out of the cloud and underwrite it like that. Well, not yet. They can't. Maybe in the future. And so they've got to ask a whole bunch of medical questions before they'll determine, okay, what pricing is going to impact and can we even offer you cover?
If I just double click on that one, it's probably like the crime rates and all that for car and home insurance. That's public data. There is only one suburb, like it's just fact almost. Is it true with each individual insurance company and the reinsurers that sit behind the insurance companies that their own internal data may be different?
Yeah, exactly. Yeah, so the reinsurers will have their own assessment and use their own medical data. And a lot of actually the reinsurers' data is actually global data sets. So not a lot of it is specific to Australia, but they use a lot of those assumptions that they gain from claims worldwide and they bring it to the Australian market and they make a lot of assumptions on what will happen. So one insurance company will have their own reinsurer and another insurance company will use another reinsurer, and sometimes those data sets will impact. So really simple examples are, family history of cancer. One insurance company will say if your mother's had breast cancer, we won't offer you, we'll offer you cover with a breast cancer exclusion, even if your mother was, age, under 60. When another insurance company will say, if your mother was age over 40 at the time, then it won't impact your cover, so we're not going to offer you an exclusion and we'll just do standard rates. And so that's just really small differences of assessments just based on, the one individual's health history and family history.
Now, following on from that, we've talked about the price, but when someone comes to Skye Wealth for insurance advice, what's the first thing that you're kind of looking at and asking before you even look at price? Are you going, how old are you, or do you have family history? Like, how do you attack it in the background? Because we did a thing up in the Facebook group. Do you want to see kind of how the sausage is made in a financial advice business, and particularly for your business in financial advice, specialising in this stuff, what are you looking at first in that process?
Yeah, I think it's pretty fair. I know a lot of other financial advice firms. I think we ask more medical questions than any other advice firm in the country.
That sounds annoying. Why would I want to use you?
It sounds like an absolute pain in the neck. But the reason why we do it is because we get really different outcomes. Because, in my view, yes, there's a bit more pain up front, but there's no worse painful experience than going through the whole process of an advisor doing all the research, giving you advice, doing an application with an insurance company, and then getting an exclusion, which another insurance company wouldn't offer that exclusion. So exact example about that family history of breast cancer. That's not the individual's experience because they haven't had any breast cancer. It's just a family history, and different insurers will assess that differently. So we ask a boatload of health questions up front because we want to get the most likely outcome for our clients when we're applying for cover, just so we're fully aware that if anyone goes ahead with insurance, that we can give them an indication that you're going to get this loading on your policy or you're going to get this exclusion, most likely.
Rather than
on the
doing
policy.
all the work and then, surprise, you actually can't insure your left knee or something like that.
Yeah, exactly. Or surprise, you're getting declined outright.
Okay.
That's the worst case scenario. If someone's gone through that whole process and doesn't end up with any cover at all. We want to be able to, in the advice stage, understand that, work with the insurance companies and negotiate what their likely outcome will be. So we do a lot of that research and then come to the client with, hey, this is the price. There may be a loading, but without doing that assessment on the medical history and the family history, we won't know that outcome. So yeah, we ask a crazy amount of health questions because we really want to dial down. And in my view, that's kind of the most important thing when it comes to personal insurance is making sure it's underwritten correctly and really tailored and dialed in. So our advice is dialed into the individual client.
Yeah. And we might get to it later in the episode, but if you've got a default policy within your super fund, for example, if you want to claim, you may have to almost the burden of proof is on you medically to prove that you didn't have a pre-existing illness, where what you're saying is you do all that pain up front for the most certainty if you do have a claim.
Yeah, exactly. Yeah, there's nothing worse when you have the health stresses on top of the financial burden that may happen to then go through the process and have to prove that, hey, you were telling the truth at the time of your application. There's a lot more certainty when we are applying for a claim that we know that we've done a lot of due diligence up front, and so we can, we've never had an insurance claim declined.
Well, there you go. This episode is brought to you by Skye Wealth. I feel I'm not doing an ad read. People have heard Skye Wealth. Yeah, I'm not doing it in front of you. People have heard of Skye Wealth if they've listened to more than one episode or two episodes. You support the podcast. You support a lot of our listeners. So thank you for being part of this. If in doubt, assume everything that ever leaves my mouth is an ad. But my name is Glen James, joined by Phil Thompson from Skye Wealth, specialist financial advisors for life insurance. And you are listening to Money, Money, Money. Before we get into it, this show is general advice only, and I've got a license to provide that advice. Full details can be found in the show notes. I'm a former financial advisor. Now I do the Money, Money, Money podcast. If you're a regular here, we call it M3, and we do a podcast called Retire Right. I've got a book, The Quick Start Guide to Investing, is available wherever good books are sold. There's a link in the show notes if you want to turn up your investing to 11 or if you're just getting started. Let's get into it. Thank you so much for being here today. Rightio. Continuing, so everyone playing at home, I've got 3 other little questions that I want to ask Phil. Then we're just going to spew your audience questions to Phil. That's how we're doing it. And if you want to really geek out and learn more about this topic, if you head over to Retire Right and subscribe there, after I record here with Phil for the Money, Money, Money show, I'm actually doing a separate episode for Retire Right. So we're not just playing 2 episodes mirrored. I'm going to do a separate one for those who might be over age 50 or so. But you will learn listening to either. So we talked about when people lob up at your doorstep and want insurance advice. How is an advisor in your business actually researching and comparing policies? How does that work?
Yeah, so there's a few things involved. So, as we touched on, health is the most important thing because that's kind of the most unique thing about any individual. We've got 2 clients, same age, same sex, same occupation, but different health histories will have different outcomes. And so there's a few things. So we always look at the health first, then we look at what existing cover is in place. So we'll always prefer to keep that cover in place if it makes sense and consider, do we need to increase that cover or or replace it outright. So there's always a consideration of the existing cover, and that's not only a thing that we do because it's a good thing to do, but it's also a legal requirement on financial advisors to always consider the existing products and if they are the most appropriate. And then we'll go, okay, how does this puzzle piece fit? So if an insurance company tells us that they're going to place an exclusion on a policy or they're not going to offer certain covers, then we will go, okay, how do we put this puzzle piece of personal insurance together? Maybe maintaining the existing cover and keeping that as is, and take out a new policy external from that existing provider. Maybe that makes sense to do that. It sometimes makes sense to increase the existing cover. Or if some clients are over-insured, which happens very few and far between, sometimes it may be, hey, you've got too much insurance cover. Let's look at bringing these numbers down. So then we look at that and then we go, okay, what are the policy benefits between the insurers? So normally when it comes to health history, there's anywhere between 3 or 4 that will come out to be number one. And then we go, okay, what are the policy features and benefits? Are any of these features that are better than the other really important to our clients or not? And then we go to price and go, okay, if one's going to provide us an exclusion and the other isn't, and it's 10% more expensive, then we will recommend the one that's slightly more expensive. Now, if the exclusion is your pinky toe and you're an office worker and it's 2 times more expensive for the one without the exclusion, then we'll go, hey, take that exclusion because it's worth the discount.
Have we ever seen a pinky toe exclusion, or it would just be a left or right foot exclusion?
It would be a foot exclusion. I was taking the example to the extreme.
You were making sure I was listening, weren't you?
Yeah, exactly.
Yeah.
So price is often the last thing, really.
Okay, so when does price enter the chat? Because as an advisor, you would have to say, based on what you've told us, aka the need, less existing wealth. So if someone's got $1 million sitting in the bank account, just floating there, and they needed $2 million of death cover, well, we can take off the $1 million.
Yeah.
So that lops up at, well, we think you need $1 million of death cover. It costs this much with this insurer who will actually insure you. So price has now entered the chat. What do we do? Do we say, okay, we've got a decision, we decrease the cover if you do not want to spend that much, or we can go to a cheaper insurer for the full cover, but you won't be covered for your pinky toe or something like that. So when does price enter the chat and can be changed? Yeah,
so we when price comes into it, before we provide the advice, our advisors will look at and go, is this affordable? Because if we're going to spend a crazy amount of money on this insurance policy, then we will make judgment calls on how to bring down the cost. So we'll make some changes to the policy, whether that's increasing waiting periods or whether that's reducing the levels of cover. But for majority of our clients, we've got young clients, and so the price of the policies aren't as expensive. So it's not as often are we bringing down the levels of cover before we meet with the client. But in our advice document, we show the clients the underwriting outcomes between different insurers. So we can kind of show that, hey, insurer A is going to exclude your foot, insurer B isn't, and we also show a price comparison. So the client can then say, okay, we've chosen insurer B that didn't have the exclusion, and it's 10% more expensive. But if the client says, you know what, I'm an office worker, I'm happy with that 10% saving, I will prefer to go with the one with the exclusion for that savings, then we go ahead with that insurer from an application point of view. So there's a bit of professional judgment. Sometimes if it's twice as expensive, we'll make the call to go to take that foot exclusion if they're an office worker. But then sometimes it's a matter of we just want to educate our clients as to the different outcomes and then empower them to make the decision that's right for them. So as long as we've done our job educating people and they feel empowered to make the right choice, it's up to the client at the end of the day if they want to bring the levels of cover down or save money. And our advisors will walk through that process on how to save money.
Because it's the worst thing, like nuance is always the first casualty in a Facebook comment, right? Where everyone's like, should I just insure 10 times my income? Someone goes and gets its quote 10 times the income. 2 things are going to happen. One, it's probably 3 things going to happen actually. First, it's the exact amount they actually need. The second thing is it's way too much than you need because you actually don't include the 500 grand cash that you got sitting in a term deposit from Nan in that equation, or 2, it's not nearly enough what you need based on your situation. And I think that's why I want people to learn from this today. If you go through the process of an advisor, they will get you to a talking point for how much we think your data says you need and what the cost is. At that point, you can say, well, not sure about that for this reason or that reason, or I don't know. We've got to get to a talking point.
That's right. And our initial form where we ask all of those financial and health questions, we actually ask if there is liquid assets that, so cash, for example, and someone has that. Then we ask the question, hey, would you want to use this if you were to pass away or become disabled to reduce the cost of insurance? And then so clients can opt in and opt out of that. And if they opt in, then that informs our calculation. If they say, actually, no, that money is for a house deposit, we're about to upgrade and we're going to use that, so it's not really going to be available for long term.
Put it on the table. Yeah.
Then the clients opt out of that. And they say, no, we don't want to use that to reduce the cover because it may be spent in a year's time.
Yeah, sweet. Yeah, sweet. Now, when you effectively look at different insurance companies, there are a handful in Australia. How do insurance companies, and I'll get you to speak to Skye Wealth, not on behalf of every financial advisor in Australia, how does Skye Wealth put someone on the shortlist or not? Or what would make an insurance company not get onto your shortlist? Yeah,
so I mean, look, we work with every insurance company in Australia. We happily recommend any insurance company in Australia. They're on our approved product list, which is jargon for we can recommend them. And so we don't really have any hesitation. At the end of the day, Australian insurance companies are so highly regulated that we're not concerned about one falling over or anything like that. There have been in the past some kind of issues and concerns, and they've just been acquired by another insurer, a larger one, or absorbed into a larger one. So we actually don't rule out any insurance company, but on an individual circumstance, there will be. So, some insurance companies will say, okay, you're working less than 20 hours a week, we're not going to offer you income protection, or most do that, but there are a few who do offer it. Okay, so maybe that's the one we do for our client, or maybe we split the policies.
Yeah, so it's akin to the mortgage broker, how someone could be like, oh, yeah, show me what brokers are available based on my situation. I do want to go with, I don't know, XYZ Bank because my mum was a manager there for 20 years of her life. It's like, that's cute. They're actually not on the table at all for your situation.
Exactly. Yeah.
Yeah. Okay.
So every individual's work, health history, financial position will dwindle down to a number of insurance companies who are most appropriate, and then once we have the top 4 who are going to offer similar terms, similar policies, then we'll base it on price. At the end of the day, price is the biggest thing that impacts us on an individual basis, and so price is a massive factor, even if it is the last factor for us.
Yeah. Finishing my point of how the sausage is made, your team, like how much time is actually spent reading the policy wording compared to looking at price and the other factors? And, Azaria, for those who are long-term listeners, Azaria is a good friend of mine. She's a financial advisor at Skye Wealth. On her LinkedIn, she always has these like nerdy things. It's like, I saw one actually the other day. Here are the 2 differences with 2 insurers with the ADHD definition. I'm like, 1, interesting. Also 2, I don't heaps care, but it's interesting. How much time are you doing it if I flagged got ADHD? Are you doing it bespoke, or are you guys across all insurance policies and all detailed wordings?
Yeah, I mean, I'd love to say all our team know every word of every PDS, and that is simply not true. We do,
Correct. If I may correct you live, Phil, I believe the wording is actually in the policy document, not the PDS.
Well, I mean, so the thing that Azari was talking about was an exclusion wording, and so how broad one insurer is when they exclude ADHD, and another insurer is so tightly defined in.
Do they still even have policy documents with PDSs?
So there's PDSs, so they have them, and policy documents is like your statement.
Yeah.
And so, so in terms of like how dialed in we get, really,
I just wanted to get one back for the Riverside comments that we had earlier when you attacked my ego.
I love it. In terms of like dialing into the policy, like most insurance companies in Australia are really good and they're very similar, and we don't have a crystal ball knowing what someone's going to claim on. So we'll always base it on underwriting first. And then if there is something that really does matter to clients, and based on their medical history or their family history, then we may lean one way if pricing is very similar. But it's underwriting first and foremost because they're the guarantees. If a significant amount of claims is going towards mental health and one insurer is not going to cover mental health and put an exclusion on and another one is, then we will happily recommend a client pay over market rate for that policy to include mental health. And so underwriting first, pricing is second, but then policy wording is important on the margins. But underwriting often whittles down to only a few insurers offering the same terms.
And I will, flog a dead horse as per. Like it's the same with a mortgage broker. It's like this mortgage provider will give you $750,000 at 5.8% interest, where this one will give you $900,000 at 6%. It's a higher rate. You'll get more. Pick one, whatever.
Yeah, and that's the idea that we think about is we believe a lot in transparency in our advice documents. We put so much information, probably too much if I'm honest, in terms of what are the likely terms each insurer is going to offer and what are the costs. So then our clients, and in our documents we actually talk about alternatives. Hey, we considered this one, but we didn't go ahead with it because we made our professional judgment to recommend what we have. However, if that's more important to you, let's have a conversation about that and talk about how do you go ahead and why did we not recommend that and why may it be a reasonable consideration? Because at the end of the day, all insurance companies in Australia are great insurers and they're all highly regulated. So they're going to pay out claims.
Love it. We'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Skye Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at skye.com.au. That's skye.com.au. And they'll point you in the right direction.
Okay, we're back. Following just before the break, we talked about mental health and underloading, and now everyone we're moving to your questions. And what I might do, Phil, I don't know if Skye Wealth is actually in our Facebook group. Can you log in, or can one of your advisors log in as the Skye Wealth page and literally go through all these questions in the MMM group and answer them?
Yep.
In case we don't get to some of these. Okay.
Yeah, we can do that. And
thanks.
we produce a heap of content as well. So we may even, if we've got a short video, include that.
I don't know if I want you advertising all your crap in my world, but sure.
Okay, sure. I was just trying to be helpful, my friend.
You are.
Trying to be helpful.
No, do it. We'll invite Skye Wealth in. And if you've got a clip, just put it in there. Okay, Karen said, application asked, within the last 10 years, has that number increased? Have you seen someone for mental health issues, including stress, anxiety, depression? If yes to any, they automatically put you on exclusions for mental health issues, especially TPD cover. My question, there's a very wide spread of seeing someone to learn some stress management techniques versus being on heavy medication for years. Surely it can't be a one-size-fits-all question, especially in the current environment where people are putting more focus on maintaining mental health. Is 10 years, is that new? Because I thought
That's
10
years
a long time.
is not all insurers will last 10 years, but yeah, it's there's a few things with this question. Number one, it isn't if you tick yes, it's an automatic exclusion with every insurer. It may be, when some insurance applications have really limited underwriting, they may have some really broad brush things. So like if you're going through your super fund, sometimes they just ask like 20 questions. And so they may just quickly put exclusions on. And that's just, they've made a judgment decision to make it really easy to increase your cover. And so less questions, but harsher outcomes often. But that's not the case that you're automatically going to get an exclusion. So really the thing that the insurers care about is, do you have any treatment and symptoms? It's not just treatment alone or not just symptoms alone. It can be, but it's not just treatment. So if you haven't seen anyone, but you have symptoms of anxiety, depression, stress, time off work because of these things, that will have an impact on your application. But it isn't a broad brush outcome.
Because the whole marriage counselling stuff used to get dragged into this crap. And
it still does.
Yeah, and a pragmatic underwriter and advisor should be like, a spade's a spade, get a grip. Like, where is the landscape on marriage counselling?
It still does impact it, but yeah, we can have conversations with underwriters. And the issue is insurance companies are absolutely hemorrhaging cash on mental health claims. So if they're
just not going anywhere near it.
Yeah, so they're being much more conservative, even though yes, and the point being that yes, today there is more focus on mental health, but from an insurer's point of view, and I'm not here to defend insurance companies, but they're the ones paying out claims. There is more focus on mental health. So being able to take a month off work for mental health is much more acceptable in this day and age. And if you're taking a month or 2 or 3, that's when the insurance companies start paying you for that time off work. So because of the significant increase in claims, it does mean from an underwriting point of view or an application point of view, they can be much more harsh when it comes to it. But that's just to say, go and speak to a financial advisor who works in this space, and the answer may not be any different based on your history, but you could have had a treatment 7 years ago that has absolutely no impact on your insurance and happy days. But it does depend on the insurers as well. And that's why we do a lot of those health questions up front.
So if you had a friend who maybe over the last 2 years spent a lot of time with psychologists and all that stuff and had spent the last 8 years on special lollies, antidepressants, and has just got off antidepressants, would you tell that friend, don't knock on any insurance company's door for at least 5 years or at least 6 years, provided you are completely symptom-free?
Well, what I would tell my friend is you can get cover without a mental health. We've seen clients get cover without a mental health exclusion.
Sorry. This friend, as I point at me, has an exclusion on his current policy.
Yes.
So I'm just thinking, should I realistically, knowing that a lot of insurers say 10 years of clear air, would I have to go, look, don't even think about doing anything until you've been symptom-free and off the pills and haven't stepped foot in a psychologist for at least 5 or 6 years?
Again, and it's so nuanced, and this is why I keep going back to, we ask a million health questions up front because two different people's situation and history does matter. So we've had clients who have been on antidepressants for a long period of time who haven't had a mental health exclusion. Now, that was a few years ago.
Oh, because they're living with it. It's kind of like, are you taking medication for blood pressure? Yep, sweet, it's well controlled, all good.
Yeah, that's right. So insurers will go, hey, we can see a really long history of well controlled. Yes, we are taking antidepressants, but it's well controlled, so we can comfortably take on that risk. Now, that was a few years ago. It's probably much harsher these days, to be fair. So it really does depend on the actual treatment, the actual symptoms, and that's why we ask a million questions, because we want to know that stuff up front, and we want to give that to the insurance company, de-identify it, and give it to the insurance company and say, What would you think? And then if we need to go into battle and get more details or more information, we'll go ahead and do that. So, my answer is it's not a one-size-fits-all when it comes to mental health. It is the biggest talking point when it comes to, in my world, that's all we seem to talk about is mental health and its treatment and underwriting and claims.
Emma said, how often should you review your insurances other than major life changes? And should this be initiated by yourself or the financial advisor?
Yeah, so life insurance is one of those things. Like car insurance, home and contents, they're easy to change because all of the data that we talked about before they're all public data. You just go into a website and you plug it in and you can just easily compare. Because life insurance and income protection and TPD is so heavily reliant on your own individual health history, the application process is so much more cumbersome, and the likelihood of getting an exclusion when you keep moving around it could potentially be high based on your own personal health history. So sometimes, we can almost, especially at this day and age, we can almost always get a better price on your life insurance, but at what cost? Because underwriting is more difficult. If you took out a policy 5 years ago, you may not have had that mental health exclusion, even if your symptoms and treatment has kind of been consistent. But today, if you go ahead with that application, you may get a mental health exclusion, or one person may. So my recommendation is always check in with your financial advisor on a regular basis, especially when life changes. But it is seen as a little bit different to a car insurance or health insurance or home and contents because of the nature of life insurance and exclusions being added to policies. And just it's so cumbersome going through the whole process.
And I want everyone to know, particularly with your life insurance, and that's the blanket umbrella term for life or death cover, total and permanent disability insurance, trauma insurance or income insurance. Time with the insurance company is your friend. Like I've been with I was just working it out. My current policies, they've been active for 13 years, and I'm not ever changing them because one, I wouldn't be able to get cover because of new health issues, and two, I'm just committed, and if there's a curly claim, there's a higher chance that they may look at it and go, "This is a long-term customer. If we've got to err one side, we'll pay the claim."
Yeah,
simple as that. And that's anecdotal, and I have seen
that's totally
them
anecdotal. I would say, I've seen it as well, but I would say that's probably the relationship the advisor has. Whoever your advisor is with that policy probably has a better influence on that claim being paid or not than you holding that policy for a long time. But I would talk about myself. I've held my policy for, 10, 12 years, and I haven't changed, and I won't change.
But you just tweak up and down when and if required, right?
Exactly. That's when it's important to just always make sure your levels of cover are accurate and appropriate. And then through that process, okay, do we review the market? Can we move this policy? Because in today's market, it is really unfortunate. We can often get better prices moving the policy, but there are short-term sugar hit price benefits more than long-term benefits, unfortunately.
Cade says, do I need life insurance from my superannuation if I don't have any dependents?
Yeah, so life insurance is a funny term. We sometimes just use the word life insurance to talk about personal insurance. So life insurance, which is death, disability cover, income protection, and there is trauma insurance as well, but your super fund won't offer you that. So life insurance is the one thing. If you don't have dependents, no one's relying on your income or you to be alive from a financial point of view, then life insurance may not be necessary. But do you rely on your income to continue to generate wealth or to just survive? If that's the case, then income protection is important. Disability insurance is super important. So, I would just encourage people when they're listening to this or thinking about it, don't just think of life insurance as just if I die, there's money paid out, because often people who don't have dependents are thinking, well, I actually don't need any of these covers.
I would say if you don't have dependents and you've got a job, income protection has got to be at the top of the list. It's just got to be.
Yeah.
Sherry, I'm paying $875 per month total on insurances through my super fund. Am I over-insured? If that's a thing for income protection, TPD, death, The super fund are not able to send the insurance contracts. Should I be concerned? Potentially. I'm 49 and have been paying premiums through the super fund for 8 years. I'm a hot mess. Before you answer that, Jess said pros and cons of holding it in super or personally. It does speak potentially that, and we can go there as part of this, and I might even get you to reply to Sherry in the Facebook group because there's probably a conversation that needs to be had offline. There's this thing in Australia where our super fund has insurance. I want to get life insurance. I'll call my super fund. You've got empirical data that shows additional cover in a group policy within super is more expensive than just going to an advisor. Jess's question and Sherry's question, with the lens of insurance in super, go for it, my child.
All right, so Sherry, there's a few things. Just the premium, like it's $10,500 per year, so it's a decent chunk of change. So going to an advisor to kind of review it, to tell you whether you're overinsured or if you're paying too much is really difficult without knowing we know your age, but we don't know your income, we don't know your personal situation, we don't know your home loans. So there's so many factors that sometimes is difficult, and as you said, nuance is sometimes lost in Facebook groups because one person could read that and go, "What an absolute rip-off! That's so unnecessary." But when you delve deep and go, "Well, Sherry's on 300 grand of income, huge mortgage, maybe a reasonable levels of cover. Yes, it's $10,000, but it may be covering that lifestyle that needs to continue to be protected. So maybe appropriate for Sherry, or Sherry could be on 40 grand of income and it's costing 25% of her income just to keep this cover. And so, okay, that's inappropriate. We're not putting enough money into super to cover that cost. So how do we balance that protection need with the cost need? And so hard to give an answer if that's too much in terms of premiums. In terms of the contracts, that's an interesting one because an insurance company and a super fund hold the contract. So if you're a member of an insurance policy within your super fund, you don't have any say on that contract. They can change it when they want to. And so you actually don't get to see the actual contract. Now, that said, they will be able to provide you with a policy document that outlines the terms and conditions of the contract and when you'll get paid, when you won't. Like all of those things should be outlined and you should be able to get that from the insurance provider. But if you've asked specifically for the contract, that's between the insurance company and the super fund. They won't give you that because
it's not your contract.
Yeah, exactly. Yeah, you're not a part of that contract. You are a policy holder as a part of that big group. So,
but could she go and say, "Could I see the insurance policy?"
Yeah, the details.
PDS,
yeah,
or the whatever.
Yeah, exactly. You log into your super statement, you somehow click to the insurance, and then there will be some details about the insurance policy. Every super fund will give Sherry that. Now, the pros and cons of holding within super. So there are lots of pros and cons. We structure a lot of our clients' policies through super, but not owned directly by the super fund. We like to own it where the policy holder or the policy owner, our clients, own the contract between the insurance company and the client, but the super fund just pays the premiums. So we can set it up that way. And that's kind of the best of both worlds. Your super fund can pay the premiums or carry the bulk of the premiums, but you get choice of insurers and you get to move that super funds in the future if and when you need to. And so there are some limitations holding it only through super. Things like no trauma insurance. No super fund will help you set up trauma insurance, which I know you've been paid out a partial claim on trauma insurance.
For my melanoma.
And so there are some of those considerations, but that's not to say go and just cancel your insurance through your super fund. Go and speak to a financial advisor because that, as I said earlier, that's a part of the puzzle piece. We may keep that and take out additional somewhere else.
And I think every episode that we ever do on the planet needs to be insurance in super means two things. It means insurance in super with the cover provided by that super company, or insurance in super set up by a financial advisor in a super shell paid from your current super fund. So my policy, I've had it for 13 years. 2 years ago, at the very start, it was paid by an accumulation fund. Then I moved, when I had my super with Life Sherpa, it was paid from that. Then I moved to my self-managed super fund and have just redirected the rollover from the... So I've had this one policy for 13 years, quote unquote, in super. I've had 3 different super funds over the years.
Yes, but the alternative is if you're with Australian Super and you go and increase your cover there, as soon as you move to any other super fund, you've got to drop that cover, take out a new cover elsewhere.
Or leave money in that super fund to keep the cover.
Yeah, exactly, and then be paying multiple admin fees.
I don't want to bury the lead. The cover that you get given automatically when you sign up for a new super fund, call it 300 death, 120 TPD. Number one, I've never seen it ever be adequate and enough for most people. Number two, if you increase that group cover, usually the price for that total package is more expensive by going direct to your super fund as opposed to a financial advisor. Now, if you go to Skye Wealth and they prove that statement wrong and it is based on price and nothing else, they will tell you, just go to that super fund.
Yeah, we've done it before. There are super funds that are well priced at the moment. And so we tell our clients, increase your cover with the super fund. They're well priced. Now, you're going to miss out on A, B and C, but it's
you
well
still
priced.
do. So back to behind the scenes of the financial advice business, if someone lobs up on the Skye doorstep, electronic doorstep.
Yeah, our website, otherwise known as.
Your website, yes. And they want to get an insurance proposal, say, and you charge, what, $500?
Yep. 330 for individuals, $495 for couples.
Yep. Now, if you're listening to this in 2031, it's probably not going to be that, so get a grip. If someone gets an insurance proposal and through that process, you recommend or you've discovered that based on price and they've got no health issues and they're young and they're healthy and all the good stuff, their current industry super fund is the best situation for them. You won't do the application at that super fund for them, but they can take that advice saying that we recommend you need $1 million of death cover. It's this much through your current super fund. We can't get it anywhere else that competitive. We suggest you go and apply. Is that how that works?
Yeah, exactly. Yeah, because a lot of the applications are hidden behind like member portals. So they've got to go in, log in as a member, and then increase their cover through that process.
So you're getting insurance advice, and part of that advice could be, well, it's better where you are, run along, or we think these policies are actually better, well priced, and all that stuff. If you want to proceed with us to set them up, we get remunerated by the insurance company to set that policy up.
Yeah, exactly. And let me just be very clear, less than 1% of our clients are we telling them to go and increase through their super fund because of all of those concerns and issues with it. And let me just dive pretty deep, because we do believe heavily in trauma insurance. We think trauma insurance is so important. And so to have that linked with your other policies,
it's better all around.
Yeah, it's heaps cheaper. So even if the life, disability and income protection is cheaper with your super fund, when we add trauma standalone outside of super, the overall cost of the portfolio, the insurance portfolio, actually becomes more expensive than just moving it all somewhere else. So that's why, and as you said, it's often not very expensive. It's often more expensive going and increasing through the super fund, and so that's why less than 1% of our recommendations will be go and increase with your super fund.
Yeah. Okay. But you're open to it if the shoe fits.
Oh, we do it. I mean, we don't even, it's not that we have a legal obligation to act in our client's best interest, which we do, but it's the fact that we always take this point of view of we don't need to make money on every single client. We don't look at every single client as a ATM
Cash
machine.
grab.
We just try and make money on. I want to be in business for the next 20, 30 years. And so we always want to make sure that, would I recommend this to my own family and our advisors, including myself, we're so incredibly skeptical that we always think, would I do this myself? If I wouldn't do this myself, then we're not going to recommend it to clients, even if we will net a higher revenue for this individual client, because we've got enough clients. we're doing okay. That we don't need to try and maximize our revenue to our business on every individual client. So we will make a professional recommendation that we will lose money on because we're reducing the cover. And so, I mean, it all sounds
and just
good,
on that,
that's kind of our
every
philosophy.
insurance company that a financial advisor uses in Australia, every insurance company pays the same rate of remuneration to the advisor. And it's not more expensive to go through an advisor because of them paying the advisor. It's the same price. And it's the same percentage that the advisor gets paid for doing that work, whether it's insurance company A, B or C.
Exactly. And every time we do say, actually cancel your cover and take it out here, we provide all the evidence as to why we've done that. And so, as I said, we probably give too much information in our statement of advice in terms of like it could sometimes be information overload. But again, I know myself and our advisors, we're skeptical human beings. So I know if I provided myself a document that just said, hey, do this, trust me, I'm doing the right thing. Well, great, I trust you, but I also want to see that you're doing the right thing. And so that's why our philosophy is we want to act in our client's best interest, but we want to show them how we've acted in their best interest.
Okay, so what I've got, Phil, I've got my stop clock and I do want to get to all these questions. There will not be more than a minute answer from you on each question, but you will have your team go back in and we'll do that right now. Alice or Elise, does it matter if you have life insurance with one provider, for example, OnePath, income protection, and TPD with another, for example, TAL? Is there any disadvantages that could occur for not being with the one insurer? And part of that minute is me saying that the question is part of the minute.
I hear. Let me talk so I can do this within a minute. We don't love it, but for if your income protection and disability are with the same insurer, that's okay. Life insurance is separate. That's not. I wouldn't go and change it just because of that. It's if we split income protection and disability, that's when it can be difficult at claim time because they're the policies that will often overlap and you've got to submit two applications. Now, that said, life insurance and income protection, there may be some overlap as well. And so you just need to be dealing with that at claim time, multiple insurance companies, multiple claims managers.
I just want to extend the minute on this one. The important thing is...
It's your show, mate. You can make up the rules how you want.
When you apply for insurance, they're going to ask you how much cover that you've got elsewhere, yes?
Yes.
Or yes? Yep. And if that cover will be replaced once the new policy is in force, yes or yes?
Yes.
Yeah. So that being said, income protection will be underwritten at a global industry level, and TPD,
life
cover will be at discretion. There's no global thing where you can't have more, like you can't have more than X amount of your income insured. So if you do need to do a top-up policy with a new insurer and you're keeping the old one, they're only going to do it up to that 70%, right?
Yeah, yes. But life insurance, if you're getting like $3 million with one company and applying with two other companies for additional $6 million, they won't offer you that much. You can't get $9 million worth of cover unless there's really special circumstances across globally. But generally, most people in the M3 community aren't getting $9 million worth of life insurance cover.
No, but there's no limit across all your policies if it's justified and if the underwriters and the reinsurers see the justification and go, yep, that makes sense.
Yeah, theoretically, there's no, but these days insurers are capping limits. So we can't, like not back in the good old days when you were advising where it was kind of unlimited for a lot of policies if you could justify it. These days insurers are saying actually we are capping out TPD at $3 million these days, capping out life insurance at $5 million.
Yeah. Okay. I want to ask you that off the record because there was always a cap on TPD. But
now it's a hard cap.
Okay. But is there a hard cap
for life
on
as well,
death cover?
Yeah.
Industry wide?
Yeah, you can get like you can make some applications with some insurers for like if you've got a big business insurance.
That's what I'm talking about. If someone needs $40 million of death cover, they'll be able to get it.
Not that easily. with a lot of difficulty.
It would have to be justified, but it's not impossible, as Ralph Wiggums would say.
It's more impossible.
Or do you have to
than it
leave
used to
the
be.
APRA system and go to like your Lloyds and offline?
It's
Anyway,
yeah,
I don't want to get into
basically
the weeds of that. Yeah,
we are capping these days. But again, we don't need to worry about that for these.
that's just the personal nerd out. I'll ask you that over coffee. Rob, how often should I check in with Phil, e.g. mortgage broker yearly, life insurance yearly, every 2 years, ? Similar to the one above that we talked about.
Emma
Do you
asked
touch
a
base
similar
with your
question.
clients? Yeah.
Yeah. So we're always available. If we always talk to our clients, when life changes, reach out to us. Someone called up the other day. They bought a motorbike, and like, do I need to change the cover or do I need to inform the insurer? All good. We don't need to tell the insurance company. That's fine. It happened after the policy's in place.
So good on them for calling.
Oh yeah, and lots of clients do, and they just want to check in, and that's the best case scenario, because we'll guide you. Actually, yes, you've now got a massive mortgage and 3 more kids. Let's increase your cover, or let's review it and work out if it's still appropriate. So always
Are there mechanisms
check in.
are there mechanisms in policies these days that life events we can increase the death cover by 20% without providing health underwriting?
Yeah, we do a lot of that. A lot of that work.
In case we don't get to it, there was some chatter in. I don't know why I do a stop clock. It never happens. There's always more questions. There's been some chatter in the Facebook group about child cover. Ali asks, please explain kids insurance and can you get it in your super? Thank you.
Yeah, so child's cover is like a combined life insurance policy and trauma policy together. So if now this isn't small medical events, these are really significant medical events that will happen to your kids. So most insurers your child needs to be over 2 years old to get the policy in place. Some insurers do it over 1. But we can get a policy in place. Now it can't be paid through your super. So because super policies can only be paid through super if it meets the SIS Act condition of release, won't go into detail because we're on the clock, but child's cover has to be paid personally.
Now, to be very clear, and I don't even like these words leaving my mouth, the child cover will pay a claim in the event of the death of a child, or as you said, Phil, a significant medical event. So we're talking cancers, we're talking strokes. I know someone who was under 16 who had a stroke. And we need to be very clear, there's no gymnastics as to, well, how much do we need and all this stuff. No. It's not replacing a kid's value or income, or it's literally to allow parents to take time off work to be with the child if they're ill.
Exactly.
Or planning a funeral and grieving. That's all. It's a luxury. And yeah.
And that's what there was a question the other day in the group just asking about it. And I responded and said, like, because someone was saying, oh, well, the kids don't have an income. Why are we getting insurance for them? That's crazy. And again,
the same reason we insure our non-working spouse.
Yeah. Exactly. Well, the same reason we insure our car. Like, if we didn't have our car, we'd need it. Like, our car's not producing an income, but we still insure that. So it's super. Well, I have it for my kids. I think it's really important. We recommend it to every one of our clients who have the kids at the age that we can get it, because we know if something happens to your kids, you're going to be taking time off work. It's kind of not even a question. And some people are fortunate where, someone in the Facebook group said their work paid sick leave and went and allowed them to go into negative sick leave for it. Amazing. But that's not an expectation everyone needs to have on their workplace.
Candice, and this was literally a comment, insurance in super for disabilities and death sufficient, or is it better not paying the extra fees and having separate insurance? What about when you combine supers or have a self-managed super fund? I don't 100% get the question, but if you have a policy set up like me and you set up a self-managed super fund, that's easy. The super fund can pay for it, stays within super. In the background, I could do what they call a cancel and reissue and have the super fund own the policy, but it's just too much paperwork and didn't care. So I'm doing the rollover.
And I guess one thing I just touch on this with Candice is the insurance policy is a insurance premium. You're paying that fee. It's not, you don't actually have an additional fee within the super fund, whether you have a policy or not, other than the premiums that you're paying for it. So just like car insurance premiums. If we had it, we're paying a premium. If we don't, we're not paying a premium.
I wanted to read this from Jess. I want to comment that I could not recommend sorting out your shat and getting appropriate and adequate insurances in place more highly. One of your webinars you did years ago with Phil made me do it, and then lo and behold, a few years later, I'm fully disabled. So thank you, thank you, thank you. There you go. Someone actually took action, and believe it or not, people get ill and people have accidents.
I mean, we deal with claims every single month, multiple claims every single month, and most people, I can confidently say, wouldn't have gotten cover if not for your podcast, Glenn. And so we have many, many people who are clients of ours who just simply would not have had it had they not been listening to this podcast and kind of gone, oh, actually, that is something I need to do. And anyone who claims, no one's gone, oh, I knew this was going to happen. I had it in my diary for this date, for this medical event to occur. We don't know what's going to happen. Now, people can make their own decisions, get empowered, educated on what they need, and whether they want to pay the premiums or not, that's up to them to make that.
But if you know about something and you choose not to do it, do not whinge if an event happens and you don't have money. That sounds very rude. Like, if you don't want to insure your car and you have an accident, don't cry that I'm uninsured and I've got to cough up 50 grand.
Sounds like you're advocating for ignorance. That's what I'm hearing.
I'm not. No. I'm just saying. Once
if
you know something
about it,
and you take action, and you might go to Skye Wealth and they say you need $150,000 of trauma cover, and you go, nah, I'm not paying $50 a month for that. Well, don't whinge when you get freaking cancer that I've got no money. Is that too rude to have on the podcast?
Hey, look, it's on brand, if I'm being honest. It's not.
I mean,
it's not a statement
we
endorsed
all lay in
by
the bed
Skye.
we make for ourselves. What's that?
I said it's not a statement I endorse at Skye, but look, we have a lot of empathy for people who don't have cover. And they feel like they need it. And that's why we are really passionate about helping everyday Australians get personal insurance cover in place, because most of the advice market has kind of left that space and decided not to help people. And that's why we get along so well, because we're both very aligned in terms of we've seen the impacts where insurances help save people financially, mentally, like the feeling of having a claim paid and being able to go, okay, I can just solely focus on this medical event and this worst time in my life, I can just solely focus on that because the bills are paid. And we've both also seen the opposite, where people didn't have cover in place. And so, yes, we're both very passionate about it, and you're just on brand being a bit more full on about it.
Well, it's just, I get it. I've got sympathy and compassion if you're uninsurable for medical events. I get it.
100%.
It sucks. But I turned a client away once because he had a $800,000 mortgage. He had a young family. And part of my advising, I want to look at everything. And he didn't want to spend, at the time, it was $800 a year from his super that had $250,000 in it for $1 million of death cover. He didn't want death cover. And I'm like, mate, you got a $1.5 million mortgage, or whatever it was. I'm like, I actually don't want you as a client because you don't respect looking after your family. And you was insurable.
Yeah.
I mean, that's probably bad to say as well, but I just,
you
the whole reason is
working
I'm
with-
sick of going to funerals of people who weren't insured and their families left behind with a mortgage and surviving parent having to go right back to work.
Yeah. And the older you get, the more of those that you unfortunately have to
At the end of
attend.
last year, I had a claim. Well, I didn't have a claim, but someone in my world had a full TPD claim for mental health and a policy that I set up 8 years ago. It's changed their life. can't work again because of PTSD. I mean, I don't know. And I get on my highest because it just absolutely kills me and breaks my heart when people go through stuff and they're not covered. It breaks my heart because they didn't know they could get the cover. That really breaks my heart. It probably breaks my heart less if they go, no, I'm a tired ass. I didn't want to get the cover.
And again, and that's everyone's got that prerogative. Just be educated and informed, and you make an educated decision. And that's what we see our job as Skye is. We just want to empower people to make the right decision that they feel is right for them. And we will push, and especially when I was advising clients, I would push a lot more than any other advisor. I'd just be like, don't be silly. Just get this policy in place. Go somewhere else and set it up so you don't feel like it's in any way conflicted where we're going to make money on this.
Yeah.
Just get it somewhere else. Not from us, but make sure you do it. And I would be much more kind of very blunt with clients and legitimate. I could care less if we made money off an individual client. I just want them insured. And so just to prove to them, and hopefully they did go somewhere else and get it in place, just to prove that, hey, this is not conflicted advice. I want you insured because we see the claims end of it.
Last questions, which we won't answer here, but I might open up when we record the Retire Right episode next. Matt says, what stage of your financial journey can you let income, TPD and life insurances go? I mean, the simple statement is you only insure things where there is a need. If that thing wasn't there anymore, would there need to be a replacement? If you had 2 cars, and I actually did this when I had, well, it was not exactly, but with my car insurance, with the 2 cars, one of them I ticked the option of hire car for crash. No, I'm getting my wires confused. I unticked both of the hire car option for crash. So I didn't want to pay more because there wasn't a need because I had 2 cars.
Yeah, exactly.
If I sold one of the cars, I wouldn't keep paying one of the car insurance. Yeah. Likewise, if I retired and stopped working, I wouldn't need income insurance. If I paid off my mortgage, had a heap of money in the bank account, if I checked out, would my spouse and family survive financially? Yes. Well, there's no insurable need, right?
Yeah, exactly.
Anyway, well, we'll leave it there. Phil Thompson from Skye Wealth, thank you for joining us on MMM, and we'll put detail. Actually, just Google Skye Wealth. Just go to Phil's team, have a chat with them. I'm regretting saying all those hectic comments that I said.
Nah, don't regret it, mate.
I mean, it's the end of the episode. Most people aren't listening if they don't like me already, so whatever.
Yeah. Look, I can guarantee no one's listening if they don't like the way that you talk about these things.
No one's listening 50 minutes in to an insurance chat if they're against insurance.
Yeah, exactly.
Or against me.
Yeah.
So there you go.
Love it. Thanks for having me, mate.
Head over to Retire Right if you want to continue this chat. We'll put that, I don't know when all these episodes, Retire Right might have gone up first. I don't know. But thank you so much, everyone. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.